Welcome to the Explainer. All right, today we are tackling something that trips up so many people, stock option taxes. We're going to break it all down into a simple, strategic playbook you can actually use.
You know, this quote just hits the nail on the head, doesn't it? So many people feel exactly this way. Stock options, they can feel like a lottery ticket, but they're also known as golden handcuffs for a reason. They represent this incredible opportunity, but they're absolutely loaded with these hidden tax traps that can catch you completely off guard if you're not paying attention. All right, so let's get into it. To really understand the game here, you gotta know the players on the field. And there are basically two main types of stock options. You've got your ISOs, or incentive stock options. These guys have some nice potential tax advantages, but, and this is a big but, they can trigger this whole other tricky tax system called the AMT. Then you've got NSOs, or non-qualified stock options. They're way more straightforward, but they get taxed just like your regular paycheck.
Okay, so this next part, this is probably the single most important concept you need to get your head around to play this game well. I like to call it the ticking tax clock.
So what's driving this clock? It's something called your company's 409A valuation. The easiest way to think about this is, it's the official price tag on one share of your company's stock. It's the price the IRS cares about, and it gets updated at least once a year.
So let's look at how this starts. Day one, you join the company, you get your stock options. Your strike price, which is just the fixed price you're allowed to buy shares at later, is set to whatever the 409A valuation is on that day. See how they match? At this point, there's zero difference between them, so no taxable value. Easy peasy.
But here's where it gets interesting. Let's say your company starts doing really well. It grows, it becomes more valuable. Well, that 409A valuation, the official price tag, it starts to go up. But your strike price, that thing is locked in. It doesn't move. And right there, you can see this gap starting to open up between the two.
And fast forward a bit. Wow, this is what we're talking about. That gap can become absolutely massive over time. Your price is still stuck back at $3, but the market value has soared. And this growing difference, right here, this is where all the opportunity is, but it's also where every bit of the tax complexity comes from. So that gap we've been talking about, it actually has a name. It's called the spread, or sometimes you'll hear it called the bargain element. And you better believe this is the number the IRS is watching like a hawk. Why? Because the bigger that spread gets, the bigger your potential tax bill is going to be when you finally decide to exercise those options.
Okay, so you see the clock ticking, you see that spread getting bigger and bigger. So what do? What are your options? Well, you basically have three main strategic moves you can make.
This right here, this is your playbook. Think of it like three different ways to play the game. First up is the safe cash out. This is for anyone who just wants to treat their options like a bonus and get the money in their pocket nice and simple. Then you've got the max leverage play. This is for the risk takers, the people who want to wait as long as possible, hoping the stock price goes to the moon before they cash in. And last, there's the long game. This is for the true believers. You exercise your options, you hold on to the shares, and you're betting that you can trade a tax bill today for much, much lower capital gains taxes down the road.
All right, so for those of you thinking that long game strategy sounds interesting, especially if you're joining a company really early on, there's a kind of special power-up move that you absolutely have to know about.
So here's what it is. It's a special move that's only available if your company allows you to do something called early exercise. That means you can actually buy your shares before you've officially earned them, before they vested.
But here is the absolute most critical part. There's the catch. You have a window of just 30 days. That's it. 30 days from the moment you exercise to file the special election with the IRS. And let me be crystal clear, they are extremely strict about this. Miss it by a day and you're out of luck. No extensions, no excuses.
So what the heck is this thing? It's called an 83B election. Filing it is basically you raising your hand and telling the IRS, hey, I want to pay taxes on this equity right now, today, based on its current value. And if you're at a super early stage startup, what's that current value? Well, it's often practically zero, or at least very, very low, which means your tax bill could be tiny, or even nothing at all.
And you know, the actual process itself is surprisingly old school and simple. You fill out a form, you put a stamp on an envelope, yes, actual snail mail, and you send it to the IRS. You give a copy to your company, keep one for yourself. The steps are easy, but remember that 30-day clock. It has to be done perfectly and on time.
So who is this move for? When should you even consider it? Well, you've got to be a true believer. You're betting big on your company's future growth. You're essentially saying, I'm happy to pay a little bit of tax now to potentially save myself from a massive tax bill down the line. And you've got to be pretty confident you're sticking around long enough for those shares to actually vest.
Okay, but let's talk about the risks, because this is a real gamble. First off, this decision is irreversible. Once you file it, there's no going back. If you leave the company before your shares vest, you forfeit them. And guess what? The IRS doesn't give you a refund on the taxes you paid. And what if the company's value goes down? Well, you've just paid taxes on gains that, poof, never even happened.
All right, let's pull all these threads together. Let's look at the final decision you have to make, because this is where we get to the ultimate trade-off. And it's something that, honestly, most people completely miss.
You see, the core dilemma here isn't as simple as which tax rate is lower. Think about it. When you exercise early to try and lock in that sweet lower tax rate, you often have to sell a chunk of your newly bought shares right away just to pay for the exercise itself and the tax bill it created. So you end up holding fewer shares in the long run. On the other hand, if you wait, yeah, you pay a much higher tax rate, but you get to benefit from the growth of your entire grant, every single share.
So it really all boils down to one single powerful question you have to ask yourself, and you need to be really honest with your answer. Is your number one goal to pay the lowest possible tax rate, or is your goal to walk away with the absolute most cash in your pocket? Because, and this is the kicker, as we've just seen, those two things are not always the same.